On the morning of February 28, 2022, the most important financial event of the last 50 years occurred, and the mainstream financial press covered it like a footnote. Russia walked into the office that morning thinking it owned $300 billion in foreign currency reserves, money it had spent 20 years carefully, methodically stacking up, and by the time the coffee was cold, that money was simply gone. Not stolen in some dramatic heist, not seized through any court process with lawyers and appeals and due process. It was switched off like a light switch. One person made a phone call and $300 billion ceased to function as money. Now, here's the question you should be losing sleep over tonight. If the most heavily armed nuclear nation on Earth, a country with a permanent UN Security Council seat, a country with enough warheads to end civilization 3 times over, if that country can have its money switched off in a single morning, what does that tell you about the money sitting in your account right now? I'll tell you what it tells you. It tells you that what you think you own, you do not own. And the central banks of the world figured that out before you did. They started acting on it immediately. You haven't. That's the problem we're solving today. Before we go any further, if you are watching this channel and you are not subscribed, you are making a financially illiterate decision in real time. The research I'm about to walk you through took months to compile. Institutional investors pay analysts 6 figures a year for this exact data. I am giving it to you for free. The only currency I'm asking for is a subscription and 30 seconds of your attention to hit that bell notification. If you won't do that, I genuinely question whether you're serious about building wealth, and the rest of this video probably isn't for you anyway. For everyone else, let's get to work. Let me walk you through the crime scene, because that is exactly what February 28, 2022 was. It was a crime scene, and the evidence it left behind is the most important financial roadmap of our generation. Russia's central bank held its reserves primarily in 3 places: US dollars, US Treasury bonds, which are just dollars with a slightly fancier outfit on, and euros, which are dollars with a German accent and an identity crisis. Now, understand what reserves actually are. They are the savings accounts of a sovereign nation. They are what a country accumulates over decades of running trade. Surpluses, of selling oil and gas and wheat and military equipment to the world, of practicing some measure of fiscal discipline. Russia had done exactly that for 20 years. $300 billion. And on that single morning in February, every dollar of it that was held in Western financial infrastructure, meaning dollars, meaning treasuries, meaning euro-denominated assets, was frozen, switched off, made completely inoperable. Now you think about what happened in the following 48 hours in finance ministries and central banks, from Riyadh to New Delhi to Warsaw to Beijing. Every single one of those finance ministers and central bank governors sat down with their teams and asked the same question: how much of our reserves are held in dollar-denominated assets? And the answer that came back in country after country sent a chill through rooms full of very serious people, because the answer was most of them. And the follow-up question was equally terrifying. If Washington decided tomorrow that we had misbehaved, if we sold oil to the wrong country, if we voted the wrong way at the UN, if we made a trade deal Washington didn't approve of, could this happen to us? The answer, legally and technically, was yes. Unambiguously, yes. And that single realization that the world's reserve currency was not a neutral store of value, but was in fact a political weapon with a trigger that one government control, that realization changed everything. It changed the behavior of central banks permanently. It didn't make headlines because markets didn't crash that day. There was no Lehman Brothers moment, no ticker tape falling, no panicked reporters outside the New York Stock Exchange. But underneath the surface, the tectonic plates of the global monetary system shifted, and they have not stopped moving since. What you are watching right now in the gold market, in the commodity flows, in the reserve diversification happening across the emerging world, all of it traces back to that single phone call on that single February morning. The dollar had been the world's safe haven for 70 years because everyone agreed it was. On February 28, 2022, the world stopped agreeing. Now let's talk about what happened next, because this is where it gets mathematical. And I am a numbers person. I do not trade in feelings. I trade in data. And the data here is frankly stunning in its clarity. Before 2022, central banks globally were buying approximately 17 tons of gold per month. That was the baseline. Steady, unspectacular, barely worth noting. After February 28th and 2022, that number went to 60 tons per month. You do the math. That is not a marginal increase. That is not a rounding error. That is a 250% increase in sovereign gold demand, sustained now for over 3 years without interruption. and it is coming from everywhere simultaneously, which is what makes this categorically different from any gold rush we have seen in modern financial history. Let me walk you through the major players, because each one of them tells you something important. China's People's Bank has been on what is now an 18-month publicly acknowledged buying spree. And I want to emphasize the word acknowledged because what China officially reports and what China actually buys are two very different numbers. Here's what we know. Approximately 57% of all central bank gold buying last year was unreported. These countries are not required to disclose their purchases. We simply see unusual volumes moving through the market. And when you look at who has both the motive and the financial firepower to account for that unreported volume, China sits at the top of that list without serious competition. Think about the mechanism here, because it is elegant in its simplicity. China runs a massive trade surplus with the United States. Americans buy iPhones, solar panels, electric vehicles, consumer electronics, all manufactured in China. China receives dollars. China then takes those dollars and quietly, systematically converts them into physical gold. They are essentially taking American consumer spending and transmuting it into the one asset that America cannot freeze, cannot sanction, and cannot switch off. That is not just a financial strategy. That is a geopolitical masterstroke. Then there is Poland, which I find to be one of the most instructive cases in this entire story, precisely because Poland is a NATO ally. Poland is a Western-aligned democracy. Poland is not a revisionist power challenging the dollar order, and yet Poland's central bank governor stood up in January and stated in plain language that he was buying gold for national security reasons. I want you to sit with that for a moment. A finance official, not a general, not a defense minister, a central banker, used the language of national security to justify a financial allocation. That tells you something profound about how the world's money managers now view the dollar system. They see it not as a financial infrastructure, but as a strategic dependency. And they are reducing that dependency as fast as they can without causing a panic. Poland sits on the border with Ukraine. They have watched the consequences of the 2022 freeze play out in real time, up close, with a front row seat to what frozen reserves actually mean for a country under pressure. They drew the obvious conclusion. And then there is Saudi Arabia, which is perhaps the most symbolically significant case of all. Saudi Arabia is not just any country buying gold. Saudi Arabia is the country that, in 1971, made the deal with Nixon that created the entire petrodollar system in the first place. The arrangement was simple and world-altering. Saudi Arabia would sell its oil exclusively in U.S. dollars, which meant any country on earth that needed oil had to acquire U.S. dollars first, which created permanent structural demand for the dollar globally, which is the primary reason the dollar remained the world's reserve currency for 50 years after America abandoned the gold standard. That deal is now being quietly unwound. Swiss industry analysts have tracked approximately 160 tons of gold flowing from Swiss refiners into Saudi Arabia over the past few years. Saudi Arabia officially says it has not bought gold. The flows say otherwise. The architects of the petrodollar are converting their dollars into gold. You should probably ask yourself what they know that you don't. Now I want to talk about physics, because gold is ultimately a physics problem, and physics does not care about your feelings or your investment thesis or what some analyst on television told you last Tuesday. Here is the physical reality of gold on planet Earth as it stands today. There is approximately $29 trillion worth of gold above ground. That is the total stock of every gold bar, every gold coin, every piece of gold jewelry, every industrial gold application, every central bank vault holding in the entire world. Of that $29 trillion, roughly 20%, about $5.8 trillion worth, sits in central bank vaults. The rest is distributed across private investors, jewelry markets, industrial applications, and retail holders around the world. Now, here is the number that should stop you cold. Mining, the entire global gold mining industry, with all of its technology, all of its capital investment, all of its operations across every continent, produces approximately $500 billion worth of new gold per year. $500 billion against a stock of $29 trillion. That is an annual supply increase of less than 2%. Gold is by definition one of the scarcest commodities on Earth, and its scarcity is a geological fact that no central bank, no government, and no Federal Reserve chairman can change by holding a press conference or adjusting an interest rate. But here is where physics becomes a crisis, rather than just an interesting fact. The central banks of the world are now buying gold at a rate that consumes essentially the entire annual mining output, 60 tons per month. means roughly 720 tons per year going into central bank vaults. Global annual mining production is approximately 3,500 tons per year. But that mining production also has to serve jewelry demand, industrial demand, retail investor demand, and institutional investor demand. When you run the actual numbers, the sovereign buyers are not just buying a significant share of mining output, they are crowding out every other buyer in the market, and they are not price sensitive. A central bank buying gold for national security reasons does not look at the price and say, that seems a bit expensive, I'll wait for a pullback. They buy because they have concluded they need to own it. They buy because the alternative, holding dollar assets that can be switched off, is no longer acceptable. And here is the final piece of the physics problem that most people completely miss. Gold does not degrade. It does not rust. It does not decay. It does not become obsolete. The gold in a central bank vault today is as good as the gold that was mined in ancient Egypt, which means that unlike oil, unlike agricultural commodities, unlike most raw materials, supply never gets a boost from recycling or substitution effects, solving the problem. What is in the ground is in the ground. What is above ground is finite and increasingly concentrated in the vaults of sovereign institutions that have no intention of selling. You do not need a PhD in economics to see where this trajectory leads. Now, I've watched enough investors over the years to know that most of you will find a way to get this wrong, even after I've laid out the thesis in language a financially literate par 12-year-old could follow. There are 3 specific mistakes I see being made repeatedly, and I'm going to address each one directly because I have no patience for watching people make avoidable errors with their financial security. The first mistake is the belief that you missed it. I hear this constantly. Gold is at record highs. I should have bought it 3 years ago. Now it's too late. This is the single most financially costly sentence in investing. Let me give you a historical data point to dismantle this thinking permanently. In the 1970s, gold ran from roughly $35 an ounce to over $800 an ounce, a move of more than 2,000%. In the middle of that historic run, gold dropped 50%, not 10%, not 15%, 50%. And every single person who looked at that 50% correction said, see, the move is over. I told you it was a bull miss, the second and larger leg of the rally. The recent 16% correction in gold is not evidence that the bull market is over. It is what bull markets do. They test your conviction. They shake out the weak hands. They make the people who haven't done the research sell to the people who have. If 95% of central banks surveyed by the World Gold Council have stated they intend to continue buying gold in 2026, and not a single one has indicated plans to reduce holdings, the structural demand picture has not changed. A 16% price correction in the face of that demand. Reality is noise. The second mistake is the all-in mentality. And if you're in this camp, I want you to hear this clearly. Concentration is not conviction. It is recklessness. A sensible gold allocation for most investors sits in the 10% to 15% range of their total portfolio. You can go higher if you have the financial durability to hold through a 50% drawdown without being forced to sell, because a 50% drawdown is not a tail risk. It is a documented historical reality of how gold moves. The wealthier you are, the more gold you can responsibly hold. Not because gold is better when you're rich, but because you have more financial runway to absorb volatility without making panic-driven selling decisions. If gold represents 80% of your net worth, you are not a sophisticated gold investor. You are someone who has made a very concentrated bet and is one bad year away from making a catastrophically timed exit at the worst possible moment. The third mistake, and this one I consider nearly unforgivable, given how much information is available, is a failure to understand the difference between paper gold and physical gold. These are not the same asset. They do not behave the same way under stress. They do not serve the same purpose in your portfolio. An ETF like GLD is a financial instrument. It tracks the price of gold. It is liquid, it is convenient, and it is perfectly appropriate if you are making a tactical trade on gold's price momentum over a 6 to 12-month horizon. But an ETF is a paper claim. It is a promise. It exists within the financial system. It can, under sufficiently extreme stress, behave in ways that diverge from the underlying physical commodity. Physical gold, held in your possession or in an insured private vault, is not a promise. It is not a claim on anything. It is the thing itself. Notice that central banks are not buying GLD. They are buying London good delivery bars and shipping them to their own vaults. They are not trusting counterparties. They are not holding paper claims. They are holding the metal. That is not a coincidence. That is a deliberate and informed choice made by the most sophisticated institutional buyers on earth. Pay attention to what they are doing. not to what is convenient or easy. So let me give you the actual framework, the mechanics of how a rational investor builds a gold position in 2025 and beyond. Because I believe in specific actionable guidance, not vague recommendations. First, determine your allocation. For most people, 10% to 15% of investable assets in the metals complex is a reasonable starting point. Within that allocation, I weigh toward physical, then minor, then ETFs in that order of priority and for that order of reasons. Physical gold is your insurance policy. It is a non-system asset. It is what you hold when you are not sure the system is going to work the way everyone assumes it. When you buy physical, buy from established reputable dealers. Your AI assistant can give you a vetted list for your specific country in about 30 seconds. Critically, buy the largest denomination you can afford. Because markup per ounce decreases dramatically as the piece size increases, a 1-ounce coin carries a higher percentage premium than a 10-ounce bar, which carries a higher percentage premium than a kilo bar. If you're making a long-term holding decision, you are throwing money away by buying small pieces when larger ones are available to you. Store it properly, a quality safe for smaller amounts, a private insured vault for significant holdings. Gold miners are the leveraged expression of the gold thesis. A mining company owns gold that is still in the ground. As the price of gold rises, the value of that in-ground resource rises, and the company's margins expand dramatically because their operating costs are largely fixed. This means a 20% move in gold can produce a 40% or 60% move in a well-run miner. That leverage cuts both ways, which is why miner selection is a craft, not a formula. But if there's enough demand in the comments for a dedicated video on how I screen and select gold miners, that is a video I will make. The ETF is appropriate for the portion of your allocation that is tactically motivated, meaning you want gold exposure today and may want to reduce it in 12 months. Liquid, low cost, easy to manage. Just understand what it is and what it is not. Now, the most important operational advice I can give you about building any position in a volatile asset: do not try to time the perfect entry. Dollar cost averaging minus buying a fixed dollar amount at regular intervals regardless of price eliminates the psychological destruction that comes from watching your entry point move against you. If gold drops 20% after you start buying, you buy more at lower prices. That is not a loss, that is an opportunity, provided you did your research and you believe in the underlying thesis, and measure your gold in ounces, not in dollars. The dollar value of your gold position is the dollar denominating itself, and the dollar is precisely the thing you are hedging against. If gold goes from $3,000 an ounce to $2,500 an ounce, but the dollar has also lost 15% of its purchasing power over the same period, your real position has not deteriorated the way the nominal number suggests. Ounces are real. Dollar valuations of ounces are an abstraction on top of an abstraction. Let me leave you with something direct, because that is the only language worth using when real money and real financial security are on the table. You now know what happened on February 28, 2022. You now know that the response to that event has been the largest coordinated sovereign gold accumulation in modern financial history. You know that central bank demand has gone from 17 tons per month to 60 tons per month and has stayed there for 3 years. You know that 95% of central banks plan to keep buying. You know that mining supply cannot keep pace with sovereign demand. You know the difference between paper gold and physical gold and why it matters. You know the 3 mistakes and how to avoid them. You have right now more actionable intelligence on this topic than the average retail investor will acquire in a decade of watching financial television. So here is your binary choice. And I mean binary. There is no comfortable middle ground here. You either take this information seriously, do your own additional research, determine your appropriate allocation, and begin building a position in a systematic, disciplined way starting this week, not this month, not this quarter, this week. Or you close this video, go back to whatever you were doing, and hope that the largest sovereign gold rush in modern history somehow doesn't affect your purchasing power, your savings, or your financial future. 2 roads. One leads somewhere. I know which one the central banks of China and Poland and Saudi Arabia are on. I know which one the World Gold Council surveys as 95% of sovereign institutions are on. The question is which one you're on. The world is not ending, but it is changing. And change rewards the people who see it coming and act, not the people who wait until it's obvious and comfortable and safe. Because by then, the price of admission will be considerably higher. Do your research, make your decision, and for the love of compounding returns, stop sitting on cash and calling it a strategy.